Welcome to Talk Tickers. If you're tuned in right now, you are probably staring at a screen full of red, or maybe you're watching the yield curve invert and just wondering how long until something breaks.
We spend a lot of time on this show chasing alpha, dissecting the latest earnings print, or, trying to parse the Fed minutes for a hint of a pivot. But today I want to pause the ticker tape. I want to take you back to a crime scene.
And it is a crime scene. I mean, literally, metaphorically, and most definitely financially.
We are going back to the 1980s and 1990s, the era of big hair, shoulder pads, and the absolute implosion of the American banking system. We are conducting a postmortem on the savings and loan crisis. Now, before you roll your eyes and say, okay, why do I care about a crisis that ended before I was born? Tell them why this matters right now.
Because if you are managing money today, I don't care if it's a personal portfolio or a billion-dollar fund, and you don't understand the S&L crisis, you are flying blind.
Completely blind.
So this isn't just history, it is a blueprint.
It's the source code for every banking failure we've seen since, isn't it? Exactly. When we were looking at the material for this deep dive, what terrified me wasn't how different the 1980s were. It was how similar they were. I mean, we're talking about duration risk. We are talking about asset liability mismatches.
We are talking about commercial real estate bubbles fueled by cheap money.
It's the same playbook.
It felt like reading a diary of 2023, didn't it?
Yeah.
I mean, Silicon Valley Bank, First Republic, Signature.
Yes.
The DNA of those failures was written in 1982.
It is the same mechanics.
Yeah.
The instruments change. Maybe it is crypto today instead of, windmills in Palm Springs. But the math of leverage and the psychology of just kicking the can down the road.
That never changes.
Never.
So here's the mission for today. We aren't just reciting dates. We're going to tear apart the engine of a banking collapse. We're going to look at the structural plumbing things like Regulation Q, the Garn-St Germain Act, and the mechanics of zombie thrifts. We need to understand how a boring, sleepy industry turned into a casino, burned down the house, and left the taxpayer with a bill that, adjusted for inflation, is just staggering.
And we can't forget the fraud, the chaos of the era. It allowed for some truly spectacular bad actors like Charles Keating.
Well, we'll get to him.
But we also have to cover the resolution, specifically the RTC, the Resolution Trust Corporation, which, it actually rewrote the playbook for how we handle distressed assets today.
Let's start with the scope of the damage, just to set the stakes for everyone, because we are not talking about a couple of small community banks going under here.
No, this was systemic. A systemic collapse. Between 1986 and 1995, 1,043 thrifts failed.
1,000.
To put that in perspective for you, that was approximately 1/3 of the entire industry.
A third of the industry. Just gone.
Gone. Evaporated.
Imagine if 1/3 of all tech companies just vanished over a decade. Or 1/3 of all biotechs.
It was devastating, especially to local economies. And the price tag, well, the estimated total cost was roughly $160 billion.
$160 billion.
And here is the real kicker for the taxpayers. The public ate about $132 billion of that.
Yeah.
The industry only covered a tiny fraction.
So to understand how we got to a bill that big, we have to understand what a thrift actually is, or was, because the word sounds so quaint, doesn't it?
It does.
Savings and loan. It sounds like something out of It's a Wonderful Life.
It does. And that's actually, that's not far from where they started. The concept goes way back to 1831.
Wow, that far back.
Yeah. And the original mandate was social. It wasn't really high finance. The goal was to pool savings from a community to fund homeownership for that same community.
Right. So it was a very local, closed-loop system. You deposit your paycheck, the thrift lends it to your neighbor to build a house, and the money just circulates.
Precisely. And the core mechanism of a thrift is very specific. And this is really where all the trouble begins. They borrow short and they lend long.
The fundamental sin of banking, if you get it wrong.
It's the tightrope they all walk. They take in deposits, which are short-term liabilities. You can ask for your money back literally at any time.
Right.
And they use that money to write 30-year fixed-rate mortgages.
Right.
Which are very long-term assets.
Which works great when interest rates are stable. And for a long time, they were.
It worked beautifully for decades. There was this joke in the industry, the 3-6-3 rule.
Oh, I love this one. It sounds like a defensive formation in football or something. Walk us through the 3-6-3.
It was the banker's algorithm for a completely stress-free life. It was simple. You pay your depositors 3% interest.
Okay, that's your cost of funds.
You lend that money out on mortgages at 6%.
Pocket the spread.
And you're on the golf course by 3 p.m.
It sounds like a pretty easy business model. You're basically printing money.
For a long, long time it was, until the inflation monster showed up in the late 1970s. That simple math of borrowing at 3 and lending at 6, it relies on one crucial assumption.
That your cost of funds stays lower than your yield on assets.
And that assumption completely collapsed.
It just evaporated.
Utterly. We entered a period where the cost of funds, what the bank had to pay to keep deposits in the door, started to exceed the yields on their assets. They were holding a portfolio of mortgages paying them 6%.
Right, from the good old days.
But suddenly they had to pay depositors 8%, 10%, even more, just to keep them from walking out the door.
That's what they call a negative net interest margin. Your INI goes negative.
Exactly. And when your net interest margin goes negative, insolvency isn't a theoretical risk. It is a mathematical certainty. You are losing money on every single dollar you hold.
Let's dig into that historical context, because the setup in the late 70s is so critical. We had massive inflation, just out of control.
Right. And to fight that inflation, Paul Volcker at the Federal Reserve did what he had to do. He jacked up interest rates aggressively.
Which brings us to a term that I see all over the source material: disintermediation. It is a mouthful, and it sounds like something a consultant would charge you 10 grand to explain, but what does it actually mean for the investor listening?
It's basically cutting out the middleman. But in this specific context, it meant depositors were fleeing the thrifts in droves.
Why?
See, thrifts had a ceiling on the interest rates they were legally allowed to pay on deposits. It was a rule called Regulation Q.
So let's play this out. I'm a depositor in, say, 1979. The market rate, what I can get from a treasury bill or a money market fund is what, 10%?
At least, sometimes much higher.
But the law says my local thrift can only pay me 5.5%.
Right.
I am not a charity. I'm not keeping my money in the thrift. It's a no-brainer.
Exactly. You are going to pull your money out and put it into a money market mutual fund, which was the new hot product on Wall Street that could pay those market rates.
So the thrifts were bleeding cash. They had two massive problems.
A death spiral.
Yeah.
First, their existing loans were underwater because they were locked in at those old low rates.
And second, their depositors, their source of funding, were leaving in droves.
So by the early 1980s, technically, the industry was already insolvent, wasn't it, if you're being honest about the accounting?
Oh, absolutely. If you mark their assets to market, yes. The whole industry was bust.
Explain that. What does mark to market mean in this case?
Well, a mortgage is basically a bond. If a thrift had to sell its portfolio of 6% mortgages in a world where new mortgages were yielding 12 or 13%, they would have to sell them at a huge discount. No one would pay full price for a 6% return when they could get 12% elsewhere.
Exactly. The value of those old bonds had just crashed. So on paper, they might have looked okay, but in reality, the industry was largely bankrupt on a mark-to-market basis by 1980 or 81.
So the government has a choice, a really tough one. They can shut it all down, admit a third of the industry is bust, which would cost a fortune and panic the public.
Right.
Or they can try to fix it. And this is where we get the legislative response. This is where it goes from a crisis to a catastrophe.
This is the pivot point. Instead of ripping the bandage off, Congress decided to double down. They passed two major pieces of legislation. First was DIDMCA in 1980.
The Depository Institutions Deregulation and Monetary Control Act.
That's the one. It did two big things. The first, and most important, is that it phased out Regulation Q.
Okay, so it got rid of that interest rate cap.
Correct. It allowed thrifts to finally pay market rates to attract deposits.
Which solved the liquidity problem. They could get cash in the door, but it made the profitability problem 100 times worse, right?
Precisely. It was like giving a transfusion to a patient who's bleeding internally. Now, they could keep their depositors, sure, but they were paying 10 or 12% for money that they were lending out on old mortgages at 6%.
They were just bleeding to death even faster.
Much faster. And DIDMCA also did something else that was critical. It raised deposit insurance from $40,000 to $100,000.
We will come back to that $100,000 limit because that is a key ingredient in the moral hazard soup that's about to be served. But then came the big one in 1982.
The Garn-St Germain Act.
This was the game changer.
Garn-St Germain was the Hail Mary pass. The logic in Washington was, okay, The thrifts are losing money on residential mortgages. That's their core business, and it's broken.
So let's let them do something else.
Let's let them grow their way out of the problem. That was the phrase they used.
What kind of new powers did this act give them? What could they do now that they couldn't do before?
It was a massive deregulation. It just blew the doors off the old model. First, it allowed thrifts to offer adjustable rate mortgages, or ARMs.
Which actually seems sensible. It transfers the interest rate risk from the bank to the borrower.
It was the most sensible part of the whole act.
Yeah.
But then it also allowed them to move into commercial real estate, CRE.
A completely different business.
A much, much riskier business. It allowed them to invest in junk bonds. It essentially turned these sleepy local home lenders into aggressive Vegas-style hedge funds.
But with federally insured deposits, that's the key.
That's the whole game.
Yeah.
It's playing with house money. And it wasn't just about what they could buy. They also changed the accounting rules, didn't they? This is the part that really just blows my mind.
It's where it gets really cynical. They relaxed capital requirements across the board. They created these things called net worth certificates, which it's hard to even describe them.
They were basically paper capital.
Yeah.
An IOU from the regulators to make an insolvent bank look solvent on paper.
Just accounting gimmicks.
All of it. And the worst one was something called regulatory goodwill.
Okay, explain regulatory goodwill, because that sounds like an accountant's magic trick.
It essentially was.
Yeah.
Imagine you have Bank A, which is healthy, and Bank B, which is failing. The regulators don't want to close Bank B and pay out the insurance.
Right, it's expensive.
So they go to Bank A and say, hey, we'll give you a sweetheart deal if you buy failing Bank B. But Bank B has a massive hole in its balance sheet, a huge loss.
So why would Bank A do that?
Because the regulators would say, tell you what, Bank A, if you buy Bank B, we will let you count that hole in the balance sheet, the loss, as an asset on your books. We'll call it goodwill.
So the loss becomes an asset.
Yes, the whole becomes an asset, and not just any asset. They allowed them to count that goodwill as regulatory capital. It was literally capital created out of thin air to mask the fact that the industry had no actual equity left.
It's accounting alchemy. It's turning lead into gold on a balance sheet.
That's a perfect way to put it.
So let's recap where we are. You have insolvent institutions, masked by fake capital, suddenly given the power to invest in high-risk commercial real estate and junk bonds using government-insured money.
What could possibly go wrong?
Everything. And it did. Immediately. We saw a massive, massive boom in the mid-'80s. S&L assets grew 56% from 1982 to 1985.
For context, that is double the growth rate of commercial banks. This was not normal growth.
And this growth wasn't evenly distributed, was it? It was highly concentrated.
Very concentrated. You saw this massive expansion in what they call the oil patch, Texas, Oklahoma, and the Sun Belt, Florida, California. This is where the zombie phenomenon really takes hold.
Define a zombie thrift for our listeners, because it sounds like something from a horror movie. And in a financial sense, it really is.
A zombie thrift is an institution that is technically insolvent. Its liabilities exceed its assets, but it is allowed to stay open by regulators who are practicing what's called forbearance.
They're just looking the other way.
They're kicking the can down the road.
Yeah.
And because the owners of this thrift have no equity left, they literally have nothing to lose, they engage in these wild go-for-broke strategies.
It's the gambling for resurrection theory.
Exactly.
Yeah.
Think about it from the owner's perspective. If I'm already bankrupt and I owe $1 billion, does it matter if I owe $2 billion? No. I'm wiped out either way. My downside is capped at zero.
At the upside.
But if I bet everything on some incredibly risky commercial development and it hits, I'm rich. I saved the bank. I'm a hero.
So the risk-reward profile is completely broken. There's no incentive for prudence at all.
None. The owner has zero downside and infinite upside. So what do? They paid way above market rates for deposits to attract as much cash as possible.
Sucking in money from all over the country.
And then they just shove that cash into the riskiest commercial projects imaginable.
And this fueled a massive commercial real estate bubble, particularly in places like Texas.
Oh, it was a frenzy. You had thrifts financing empty shopping centers in the middle of nowhere, speculative office towers that were never leased, condo developments that never had buyers. It was a complete capital allocation disaster.
And then the music stopped. The triggers hit.
The first trigger was the collapse of oil prices in 1986. That just crushed the Texas economy. If you were a Texas thrift heavily invested in local CRE, your collateral just evaporated overnight.
And the second trigger was also in 86, but it was legislative. The Tax Reform Act.
Yes. This is a bit in the weeds, but it's crucial. The 1981 tax cuts had created all these tax shelters for real estate. You could write off passive losses.
So doctors and lawyers were buying shares in strip malls just for the tax write-off, not because it was a good investment.
Exactly. The 1986 Act eliminated those loopholes. Suddenly, investing in an empty strip mall wasn't a good tax dodge anymore, and commercial property values just plummeted.
So the bubble bursts, and the insurance fund, the FSLIC, it goes bankrupt.
The FSLIC was completely overwhelmed. They did not have enough money in the fund to pay off the depositors of all these failing banks. So what do?
They stalled.
They kept the zombies open even longer, which just made the eventual hole deeper and deeper.
This finally leads us to the cleanup phase, specifically FREA in 1989.
The Financial Institutions Reform, Recovery, and Enforcement Act. This is the government finally admitting, okay, we can't hide this anymore, the house is on fire.
What did FREA actually do?
It was a complete reset. It wiped the slate clean. It abolished the FHLBB, the Federal Home Loan Bank Board, and the FSLIC. It was a complete repudiation of the entire previous regulatory regime.
And in their place.
It created the Office of Thrift Supervision, the OTS, and crucially for our story, the Resolution Trust Corporation, or RTC.
We're going to dive deep into the RTC in a few minutes because their mechanics are just fascinating. But first, I want to unpack some of the practical mechanics of how these thrifts actually operated and failed. There's a player here that often gets overlooked. The Federal Home Loan Bank System, or FHLB.
And FHLB is absolutely critical to understanding this. Think of them as the lender of next to last resort.
Not the last resort, which is the Fed.
Right. They were created way back in 1932 to provide liquidity to thrifts. They give what are called advances, which are just collateralized loans, to their member banks.
And in the 80s, these advances played a specific and kind of sinister role in keeping the zombies alive.
They absolutely did. When depositors started fleeing a troubled thrift, or when a thrift needed a quick $1 billion to fund a risky CRE project, they would go to their local FHLB and borrow money.
I recall a stat from the sources. It was something like failed thrifts increased their FHLB advances by 84% in the 2 years before they finally collapsed.
It's a massive signal. It was a telltale sign of distress. They were replacing stable core deposits with these wholesale FHLB loans.
But why would the FHLB keep lending to a bank that's obviously circling the drain?
Because of one very important detail. And this is the practical mechanic investors really need to understand today. The FHLB has a superlien.
That sounds like a superpower, or depending on who you ask, a supervillain power.
It sort of is. It means if a bank fails, the FHLB gets paid back first, before anyone, before the depositors, before the FDIC insurance fund.
So the FHLB is perfectly safe lending to a burning building because they know they are first in line for any salvage.
Exactly. This creates a really dangerous distortion. The FHLB has no real incentive to cut off a failing bank. In fact, by continuing to lend to them, they allow the bank to stay open longer, to burn through more of its assets, and to engage in more and more risky behavior.
And when the bank finally does collapse,
the FHLB takes its money off the top and leaves, and the insurance fund, and ultimately the taxpayer, is left holding a much, much larger bag.
The sources mention that this exact dynamic played out with Silicon Valley Bank and First Republic in 2023.
It is the exact same playbook. SVB loaded up on FHLB advances right before the end to cover the deposit flight. It's a mechanism that delays failure, but it massively increases the cost of that failure.
Okay, let's talk about moral hazard and that deposit insurance limit. We mentioned it went from $40,000 to $100,000. How did that change the behavior of the average depositor?
It completely killed market discipline. It just nuked it. If I am a depositor and the federal government guarantees my money up to $100,000, I don't care if the bank is solvent. I don't care if the manager is gambling on junk bonds or buying racehorses with my money.
You only care about one thing.
Who pays the highest interest rate? That's it. My money is safe either way.
So the riskiest banks, the zombies who were the most desperate for cash, would offer the highest rates.
And money would just flood in from all over the country. This really birthed the concept of brokered deposits.
Okay, explain that. How does a brokered deposit actually work?
So you had big Wall Street brokers firms like Merrill Lynch who would gather up huge pools of cash from their investors. Let's say a broker has a client with $10 million to invest.
Okay.
They would take that $10 million and chop it up into 100 separate chunks of $100,000 each.
To stay under the insurance limit?
Exactly. Then they would use a computer to scan the country for the thrifts offering the highest yields. And they would wire those $100,000 chunks to 100 different thrifts.
Hot money.
The hottest of hot money. This mechanism allowed a tiny thrift in a town of 5,000 people to suddenly have $1 billion in deposits to speculate with. There was no local customer loyalty. It was just yield chasing, pure and simple, all funded by the taxpayer guarantee.
We absolutely cannot talk about the S&L crisis without talking about fraud. And the poster child for this, the one everyone remembers, is Charles Keating and Lincoln Savings and Loan.
Charles Keating is the archetype. He is the final boss of the S&L crisis. He bought Lincoln S&L in 1984. In just 4 years, he grew its assets from $1.1 billion to $5.5 billion.
That is just explosive, unbelievable growth. How did he do it?
He used those broker deposits we just talked about to buy junk bonds and raw land. He was very heavily involved with Michael Milken's junk bond operation at Drexel. But the fraud here wasn't just risky investing. It was something called control fraud.
Explain that concept, because when I think fraud, I think of someone stealing money out of the vault. This was different.
It's much more sophisticated. Control fraud is when the executives at the top use the institution itself as a personal piggy bank and as a weapon. It is using the legitimate mechanisms of the bank to create fake paper profits.
And the most famous example of this with Keating was the land flip.
The land flips were legendary. I love a good scam breakdown, so let's walk through how this works.
Let's do it.
Okay, so imagine Lincoln S&L buys a piece of raw, worthless desert land in Arizona for $3 million.
Yeah.
It just sits on their books at a cost of $3 million. They can't book a profit.
Right.
But Keating wants to show big earnings so he can pay himself a massive bonus. So he finds what's called a straw buyer.
A fake buyer, essentially.
A cooperative buyer.
Yeah.
Let's say he lends this guy $20 million of the bank's own money. And it's a non-recourse loan, which means if the guy defaults, Lincoln just takes the land back. No harm, no foul to the borrower. The guy then takes that $20 million that Lincoln just lent him, and he buys that piece of desert land from Lincoln for $20 million.
Wait a minute. So Lincoln bought it for $3 million and then sold it for $20 million.
Boom. Lincoln immediately records a $17 million profit on its income statement. The stock goes up. The regulators see a highly profitable bank. Keating takes a multi-million-dollar bonus based on that fake profit.
But the bank is now holding a $20 million loan that is secured by a piece of dirt that's only worth $3 million.
Exactly. It's a ticking time bomb on the balance sheet. But for 2 or 3 years while the music is playing, everyone is getting rich. And when the loan finally defaults, well, Keating has already cashed his bonus checks and is long gone.
That is just, it's so sinister. And he did this at scale.
Industrial scale. And the worst part of it all, he needed a constant flow of cash to fund these fake loans. So he had his tellers in the bank branches selling bonds.
This is the part of the story that just makes my blood boil. The subordinated debentures.
It is absolutely heartbreaking. You had retirees, elderly people coming into a Lincoln branch. They see the FDIC sticker on the door. Think everything inside is safe, government-backed.
Of course.
The teller, who is incentivized with bonuses, says, hey, why keep your money in a boring CD at 5% when you can buy this special corporate bond at 10%?
They didn't tell them it wasn't insured by the FDIC.
No, they actively misled them. They were selling high-risk, uninsured junk bonds issued by Keating's parent company, American Continental, to grandmothers who thought they were buying the equivalent of a government-backed savings account.
What happened to them?
When Lincoln finally failed, 23,000 seniors lost their entire life savings. Wiped out.
And Keating wasn't just a businessman, he was a political operator. This brings us to the infamous Keating 5.
This was a massive political scandal that reached the highest levels of the U.S. Senate. Keating had donated about $1.3 million to 5 specific U.S. senators: Alan Cranston, Dennis DeConcini, John Glenn, John McCain, and Donald Regal.
So when regulators from the Federal Home Loan Bank Board started looking into Lincoln in 1987...
Keating called in his chips. He effectively got these 5 powerful senators to pressure the regulators to back off their investigation.
He used his political influence to intimidate them.
Absolutely. He met with them. The senators summoned the regulators to a meeting in the Capitol. It was pure intimidation, and it worked. The regulators delayed seizing Lincoln for 2 more years.
And in those 2 years, the zombie just kept gambling, digging the hole deeper.
Correct. That 2-year delay ended up costing the taxpayers an additional $1 billion, maybe more. The total cost to clean up Lincoln alone was $2.6 billion.
It's just a stark reminder that regulation is always, at its core, political. But eventually, the House of Cards collapsed and the government had to clean it up. So enter the RTC, the Resolution Trust Corporation.
The RTC is fascinating because it was basically the world's largest liquidation sale. Their mandate was to take over these thousands of failed thrifts, fire the management, and sell off all the assets.
But selling those assets couldn't have been easy. I mean, we were talking about half-finished strip malls, raw land in the Arizona desert, portfolios of bad loans. If you just dump all that on the market at once, you crash real estate prices everywhere.
Exactly. You couldn't just have a fire sale of $400 billion of real estate without crashing the entire U.S. economy.
Yeah.
So the RTC had to innovate. They couldn't just be an auctioneer. They had to be financial engineers.
One of the big innovations I saw mentioned in the notes is something called equity partnerships. How did that work?
The RTC realized pretty quickly that they weren't good at managing real estate. They're government bureaucrats, not property developers. So they would partner with private sector investors. They would package up a portfolio of bad assets, say a bunch of half-empty office buildings in Dallas, and put them into a partnership. The private investor would put in some cash and agree to manage the assets. The RTC, in turn, would retain a limited partnership interest.
So if the private investor turned those assets around and sold them for a profit years later, the taxpayers got a cut of the upside.
Exactly. It was brilliant. It aligned incentives. It prevented the RTC from having to fire sale everything for pennies on the dollar during the depths of the recession. It let the private sector, which is good at this stuff, do the heavy lifting of working out the loans and managing the properties.
And they also basically pioneered the modern CMBS market, commercial mortgage-backed securities.
This is huge for the investor context. Before the RTC, there wasn't really a standardized liquid market for securitizing commercial mortgages. You had RMBS residential mortgage-backed securities, but commercial loans were seen as too lumpy, too unique.
So how did the RTC change that?
Necessity is the mother of invention. The RTC had so many billions of dollars of commercial loans on its books that they needed to clear them. So they worked with Wall Street to create the structures to package them into bonds.
They created the market.
They effectively birthed the modern CMBS market out of necessity. They standardized the documentation, the risk tranches, the legal frameworks. It's a market that's trillions of dollars today, and it really got its start in the RTC's cleanup operation.
It is truly amazing how crises often drive financial innovation. So the final stats on the RTC, it closes 747 thrifts, it sells off over $450 billion in assets, and it recovers over 85% of the book value. It shuts down in 1995.
It was, by most accounts, a successful cleanup operation, albeit a very, very expensive one. It showed that you can resolve a massive banking crisis if you are willing to take the pain and be creative about the resolution.
Okay, let's pivot now to the investor context. If I am an investor today looking at a bank or any financial institution, what are the red flags from the S&L crisis that still apply? Because they really, really do.
The biggest one, the one that never changes, is rapid asset growth. We saw it with the thrifts, 50% growth in just a few years. We saw it with Silicon Valley Bank in 2021. If a bank is growing its assets significantly faster than its peers, you have to ask yourself, where are they finding these loans that no one else can?
There's an old saying in banking, growth is the enemy of quality.
Always. You can always grow a loan book if you're willing to underprice risk. If everyone else is lending at 6% and you're willing to lend at 5%, you get all the business, but you'll also get all the eventual defaults. Banking is a mature industry. If someone is growing like a tech stock, you need to run.
Another big red flag is a sudden asset mix shift.
Right. We talked about how thrifts went from 80% residential mortgages down to under 60. They suddenly pivoted into things they had no expertise in: CRE, development loans, junk bonds.
Right.
If you see a bank suddenly pivoting into a new complex asset class, that is a huge gamble for resurrection signal. It usually means their core business is failing and they're desperate.
And geographic concentration, that was a huge factor. The S&L crisis was very regional. It was a Texas crisis, a California crisis, a Florida crisis.
Diversification matters. It sounds simple, but it's crucial. If a bank's entire loan book is tied to commercial real estate in one city or to one industry like tech startups for SVB, that is a massive single point of failure. You want a bank that reflects the broader economy, not just a specific zip code or industry.
Let's talk about CRE exposure specifically. It feels like commercial real estate is the recurring villain in so many banking crises.
It's highly cyclical and it's highly illiquid. In the 80s, tax reform and overbuilding killed CRE. In the early 90s, there was another CRE bust. In 2008, it played a huge role. Today, we worry about work from home and interest rates killing office CRE.
Right.
The lesson is that CRE is not like a stock you can sell in a second. It takes years to build a tower, and by the time it's finished, the economy might have completely changed. high concentration in CRE is always a risk factor to watch.
And finally, the big one. The one that seems to catch even the smartest people off guard time and time again, duration risk.
This is the physics of banking. It's gravity. It cannot be negotiated with. If you hold long-duration assets like 30-year mortgages or long-term treasury bonds, and you fund them with short-duration liabilities like deposits, a rate hike cycle is an existential threat.
In the 80s, the thrifts were just completely unhedged.
They were naked long duration. They had no protection. Today, banks have better hedging tools, interest rate swaps, derivatives. But as we saw so clearly in 2023, they don't always use them.
Or they use accounting tricks, like classifying assets as held to maturity to hide the mark-to-market losses.
Exactly. But that doesn't change the underlying economics. The math of duration risk has not changed one bit. If rates go up, the value of your old low-yielding bonds goes down, period.
We should also touch on some of the regulatory changes that stuck around. What is PCA?
Prompt corrective action. This came out of a 1991 law called FDICA. It was a direct response to the S&L crisis. It basically mandates that regulators must intervene when a bank's capital dips below certain legally defined levels.
So no more wait and see. No more forbearance.
That was the idea. They can't just wait and hope things get better. The law forces them to act. They have to close the bank before its capital hits zero to protect the insurance fund. It removed the regulatory discretion that let the zombies roam for years in the 80s.
It was designed specifically to kill the zombie thrift problem.
Theoretically, yes.
Yeah.
If the capital numbers are bad, the regulators' hands are tied. They are forced to act.
And we also got risk-based premiums for deposit insurance after this.
Right. Before the crisis, every bank paid the same flat rate for insurance, whether they were a super safe bank or a casino like Lincoln S&L. Now, riskier banks have to pay more for their deposit insurance. It tries to reintroduce some market discipline.
So we have covered the history, the mechanics, the fraud, and the cleanup. It's been a lot. Now, I want to boil this all down for the listeners. What is the one question they should be asking when they look at any financial institution?
The one question is this. Is the institution funding long-term illiquid assets with short-term flighty liabilities?
And why does that one question matter above all else?
Because when the yield curve inverts, or when liquidity in the system dries up, that fundamental mismatch is what transforms a simple liquidity problem into a full-blown solvency crisis. And it happens almost overnight, regardless of how good you think the underlying assets are.
It doesn't matter if the loans are good if you can't fund your operations today.
Exactly. Solvency is an opinion. Liquidity is a fact. You can argue all day about the value of an office building in 5 years. You cannot argue about a wire transfer that needs to go out in the next 5 minutes.
That is a fantastic line. Okay, let's wrap this up. Recap the key takeaways for us from this whole deep dive.
Okay. First, the S&L crisis was a perfect storm of macro forces, runaway inflation, and really bad policy deregulation without proper supervision.
They took the brakes off before they taught them how to steer.
That's a great way to put it.
Yeah.
Second, forbearance letting zombie institutions stay open is incredibly expensive. It cost the taxpayers billions because they didn't just rip the bandage off and shut things down fast enough.
And third,
The fundamental mechanics of a banking failure rarely, if ever, change. It's always some combination of leverage, duration mismatch, and asset concentration. It's the same story every time.
and we saw how the supposed fix, the Garn-St Germain Act, actually made things infinitely worse by encouraging all that gambling.
It's the law of unintended consequences. Trying to help them grow out of the problem just ended up creating a much, much bigger monster.
Before we sign off, I want to leave the listeners with one final thought. We've talked a lot about the RTC and the cleanup, and we often think of these crises as being purely destructive. But the S&L crisis, in a weird way, actually modernized the U.S. banking system.
It did.
It gave us risk-based capital rules. It gave us the CMBS market we talked about. It gave us stronger audit requirements.
The system is more robust today because of the pain of the 80s. But the human element, greed, fear, and the unshakable belief that this time is different, that part never changes.
No.
The zombies of the 1980s are just a timeless reminder that when you take away the downside for risk takers, they will inevitably crash the car.
Markets change, but the math of leverage and duration does not. Thanks for listening to Talk Tickers. We will catch you on the next deep dive.
Stay solvent, everyone.